I don't even know this. India market suffered its worst day since June 2022, plunging 2.2%. But if you look at the overall trend, you would see that this could be a healthy correction from a year of climb, correct? That is why India's stock market is right now the 4th largest in the world, overtaking Hong Kong. Now it only ranks behind US, China and Japan. Not just that, India is named by IMF as a star performer, projected to contribute 16% of global growth. Wow. IMF also reported that India is on track to be one of the fastest growing major economies in the world. In today's discussion, we'll talk about investing into India equities and why it needs to be on your watch list. If you're curious, continue watching. Hi guys, welcome back. Without further ado, let me show you Sensex index. Sensex has been on a tear for the last 5 years and doubling in that process. But investing, we don't just see the price, correct? We need to understand what is the opportunity. Corrections like this today could be a time to start buying than to run. So for today, I'll be discussing this whole investment opportunity in 4 key parts. The first is what exactly is India's economic growth. The second is what's the difference between investing in India and investing in Chinese. The third is it too late to invest into Indian equities right now? And last but not least, the fourth, how to exactly invest into Indian equities. So let's start with the first part, India's economic growth. I got a feeling you know this already. India has right now the largest population in the world. You know, when I traveled to Bangkok recently, I see a lot of tourists coming from India. India not just has the largest population, it has also a positive population growth rate. About half of its population is under 25, which suggests that economic growth should not be constrained for the next few decades ahead. China, on the other hand, is seeing a negative population growth. Its population pyramid is inverted. Go check it out. Long story short, that is a consequence of its one-child policy previously. So this whole quote is to show that India is on course to become a global superpower. In terms of economic growth, IMF has projected India's growth to outpace China for 2023 and also in this year 2024. Projecting forwards, it is expected to be growing at 6.5%. And as a consequence, by 2027, it should overtake Germany as the 4th largest economy and overtaking Japan as the 3rd largest by 2032. Does this sound like China 20 years ago not? Quite familiar, correct? So with that, let's move on to the second chapter, which is what's the difference between investing in India and Chinese companies. The first shot I'll take is on global companies now seemingly moving away from China. Apple, for example, is one of the latest to capitalize on India's fast-growing economy and reduce its reliance on China. The political instability is well documented already, and this pandemic has already reminded many MNCs to not over-rely on China too much. Other beneficiaries of this notion of moving out from China include not only India, but Vietnam, for example. But there's also a difference. Top Indian companies are also listed in US, and that's different from many other emerging economies. If you see, this is a list of Indian companies listed on NYSE. Among them are Infosystems, HDFC and Make My Trip. Now these companies are facing a slightly different scenario from Chinese companies, correct? Because for Chinese companies, there's always this looming threat of delisting. It's been such a topic that's damaged investors' confidence for the last 2-3 years. So if you see in terms of stock price, you would realize that pulling some of them up, it looks very different from the fate of Chinese companies. And there's another point to note. Of these 3 names, do you know any of them personally or not? Leave in the comment sections, because if I flash a chart of Tencent, Alibaba and Meituan, I guess you'll know them a lot more closer. They have all been covered on YouTube a lot more than these 3 companies from India. But don't underestimate them. If you have an Indian friend, you would realize that these are household names there. So with that, let's move on to the third chapter, which is regarding investing. Is it too late to invest into Indian equities or not? Quoting from Dina Ting, Head of Global Index Portfolio Management at Franklin Templeton, people are recognizing that this is a market that they can't ignore. India is benefiting from its own reform agenda and broader global trends. This seems the total opposite from China, correct? And that is why India is now undeniably the leader in emerging markets and stepping on China's toes. Another interesting part at the bottom of this article is there's a lot of infrastructure development and there are plans to build 80 new airports in the next 5 years. If you read around, there are a lot of stories of infrastructure investment in India right now. Reinforcing a point, China did all this 20 years ago and look at its trajectory. Could this really be your opportunity to invest in the next superpower 2.0? Having said that, investing is about understanding risk, correct? And it's about doing critical thinking and knowing about valuations. That's why I prepared some contrary reports to give you a balancing point of view. And before you get there, help me smash the like button because it's taken our team hours to prepare this presentation for you. And smash the subscribe, especially if you like content like this that helps you in your investment journey. I'd like to pull up some views from the opposing side. It's mentioned over now that Sensex index is trading at 21.4 times. Actually, latest is around 25 already. And that is similar to price earnings ratio in US. That is way higher than MSCI Emerging Market Index and Europe's index, suggesting that Indian equities are overvalued. Chief Investment Officer JP Morgan Asset Management has warned that Indian equities have traded at similar valuations 4 occasions in the past 30 years, and each time they resulted in a 5-year period of stagnation. If you'd like to see the price earnings ratio, I have this chart to show you also. It is true that right now Indian equities are not cheap. They're hovering close to 25 times, and an easy conclusion is that it's at least fairly valued already. But again, 25 times is much cheaper than US big tech, which is 30 plus times currently. But if we see the rest of Asia, you would realize, for example, Hong Kong is only at 10 times, super depressed. Indonesia, 13 times. Singapore, 13 times. Taiwan, which has lost semiconductors, 17 times. Japan, which has rallied because of yen devaluation, 19 times. So all in all, from this summary, it's easy to think that India is overvalued. It's been like India pulling up the entire Asian and emerging market index itself, like big tech putting up S&P 500. Because what we can see from charts is that in the blue line, that is Indian equities. Yellow line, that is MSCI emerging market equities. Still not doing too bad because of the blue line pulling it up. The light blue line is Hong Kong equities, and you would realize that it's on a total opposite trajectory. But just now, Chief Investment Officer JP Morgan Asset Management mentioned 20 times price earnings has seemed to correlate to a share price tanking for a few years. When I plot this price earnings ratio together with Sensex index, it doesn't seem so on first glance. So I'm not too sure if that evidence is reliable or not. But again, it's food for thought before you start investing. With that, let's move on to the 4th chapter, how to invest into Indian equities if you're really interested in. So now I show you some charts, correct? And the simplest way is to actually invest into MSCI India UCITS ETF with the ticker INDA. This ETF will give you Indian equities, and you see from this top 10 holdings that predominantly Indian equities are dominated by banks and industrials. But personally, I believe that valuations matter. Maybe it's better for most of us to be broadly diversified than punting everything into a region even though it has very strong growth potential. So what I'll suggest instead is to look more at emerging market equities, and it can be done via this ETF, EIMI, MSCI EM UCITS ETF. If I were to pull out the chart again, you would realize this is the yellow line over there. Because it's diversified, the volatility is lower. This ETF would give you 17% allocation to Indian equities. And you can sleep tight that if, for example, China starts to rally again, being broad-based will give you some exposure there already. Let me know your thoughts in the comment sections. And as always, I hope you've enjoyed this discussion. And if you have so, maybe I'll introduce you to this previous video I've done, which explains on good investing. Check that out and hopefully it can help you in your investment journey also. And I'll sign off from here. Take care as always. Goodbye.